Thank you very much. Thanks for having me, and very much looking forward to this. I think Brian and I met back in 2006 when you guys really were sort of no names in Silicon Valley, and here we are 7 years later, and you're on stage. But let's talk a little bit about how you guys got started. So 2003, right? And so 10 years ago, 2003, and we all know what was happening in 2003. So maybe just like, what the hell were you thinking?
Yeah, you're absolutely right, Ari. Back in 2003, if for those of you who recall, that was the depths of the bust. 2003 was the year that the least amount of venture capital new funds had been raised. And my partners and I were thinking about a new fund, but we were scared because most VCs could not raise funds in this environment. But what we saw was that more and more technology companies were building service businesses. And we'd experimented with that during the bubble, and we learned a lot of lessons about what it takes to build a service business. And in 2003, what we saw was VCs were retreating. A lot of them had grown too large. A lot of them had expanded into sectors that they really had no business investing in. And as the bust started to unfold, VCs were retracting back to categories where they'd made money back in the 90s. So no VCs were really interested in service businesses, and we saw that that was the opportunity for us. There was no term software as a service at the time, so when we were raising our first fund, we were kind of waving our hands and talking about technology companies building service businesses.
And did you raise your first fund right away, or did you invest a little bit of your own money first and sort of show some results?
So we started raising money in 2003, but it took us 15 months to raise our first fund.
Which was a couple $100 million, was that?
It was $125 million. So while we were raising money for that extended period of time, we thought we still had deal flow. We knew people in Silicon Valley who were starting businesses, and we thought a good opportunity would be to invest our own money while we are raising institutional capital. So our first investment was in Salesforce.com, and we negotiated to buy $1 million worth of shares, but we had no money. So we went around and we each ponied up some of our own personal capital, and we found some friends who ponied up some money. And is the stage shaking?
Yeah, I don't think we're having an earthquake, but.
So we ended up cobbling together really a very small amount of money to buy shares in Salesforce. That was at about $1.60 a share, which before the stock split would be the stock split a few months ago of 4-to-1. So currently it's trading about $45 a share after the 4-to-1 split, so maybe $180 a share now.
And are you still investors?
Well, we distributed the shares to our investors. Of course, we were major investors, so I think we all hold a few shares, but most of it has been sold.
And how did you get into that deal? Who knew Mark Benioff, or who knew someone at Salesforce to make that happen?
So one of my partners, Gordon Ritter, had not been in the venture business, but was a serial entrepreneur. And he sold a company to IBM in the bubble. And while he was working at IBM, he met Mark Benioff, who had founded Salesforce and was trying to structure a partnership with IBM. Over the course of a few months, Mark and Gordon left to form a new company. Mark had hired John Dillon to be the CEO of Salesforce in the year 2000. And Mark and Gordon went off trying to create a new company, and they called it Software as Service. So there was only one A in the acronym, but it was really the precursor of the term that we use today.
Wasn't there already a SaaS Institute at the time?
Yeah, but it had nothing to do with Software as Service.
Right.
I don't know what that stood for. So anyway, Mark and Gordon went around Silicon Valley in 2001 trying to raise money for this concept, software as service. Their idea was, gee, we could run a data center in the cloud that developers could just log into, write their software, and then deploy it straight from that server. Today, that is cloud computing, but this was in the year 2001, and the market wasn't ready for it, and certainly VCs were not ready for it. So in the end, Mark arranged for Salesforce to buy that company, and that's really how Gordon and Mark Benioff became friends.
And how? So how did you, Gordon, and Jason all come together to start the firm?
So it was kind of a random set of events. One of the VCs that Gordon and Mark went to was Jason Green, who was at USVP at the time, and Jason was quite intrigued with the concept, but he couldn't get his partners to go along with it. So Gordon naturally approached Jason as a result of that interaction. Meanwhile, I was with a firm called St. Paul Venture Capital. It's funded by a big insurance company called Travelers Insurance. And I had opened a Silicon Valley office for them, but they were, during the bust, they were trying to shrink the firm. And so I had made up my mind that I was going to spin out and stay in Silicon Valley and form a new firm. And I approached Jason, who was a friend of mine, and the three of us got together.
So I remember when we met in 2006 and you were talking about this software as a service. And, for me at the time, it was basically, there was Salesforce, and that was pretty much it. I mean, there were some companies emerging. SuccessFactors, I think, was emerging at the time. But it was a really odd, for me, thinking about the world in 2006, where, there wasn't a lot that was particularly interesting happening outside of Google and some networking stuff. And so you're talking about software as a service, as an investment opportunity, and I couldn't get my head around, outside of sales, where else do you go with this thing? What was it that you saw either specifically with Salesforce or the possibility to distribute via the cloud when we weren't even talking about things that way at the time?
Well, we could tell that this trend was happening, that technology companies who back in the bust, they were just selling software like crazy, selling all kinds of technology companies were selling like crazy. And then the bubble burst and everything stopped. And so what we saw from our portfolios at the time was the companies that had to sell new stuff to customers, they were going out of business because nobody was buying anything. Whereas there were companies in our portfolio that were staying in business not by selling new customers, but by making their current customers delighted and extracting a recurring revenue stream. And so in the very tough times of the bust, we saw that there were companies that were succeeding and growing even when in the worst of possible times. And so when we were raising our fund, we weren't telling investors that there was going to be a great IPO market or there was a great M&A market. We were telling them there's a way to fund companies that can grow in the toughest times. And interestingly enough, 5 or 6 years later, in the financial crisis of 2008 and 2009, that theory got put to test, because at this point we had a full portfolio of SaaS companies, and we got to see whether or not that was true. And I think if you look at the public market, as well as the companies that we saw in our portfolio at the time, it is true. These companies can continue to grow even when purchasing kind of is shut off temporarily.
So fast forward to the present. Now you've got multiple companies that have gone public just in the last year and a half at multi-billion-dollar valuations, and Workday is over $11 billion now, which is astounding. I think PeopleSoft sold for like 12, right? So they've already recreated that value in just a few years. Now this is like the way that business gets done now, right? I mean, you can't start an enterprise software company with it not being a SaaS business, right? So that's the way that all VCs see it now, which would seem to make your job a lot different because you're no longer the only one in the room. You're no longer the only one that'll take a meeting with that guy who's trying to do something crazy. Now it's just sort of the way things get done. So where do you see your position now relative to all of the kind of $500 million, $1 billion funds that are chasing similar strategies?
Yeah, I think we had a lot more fun when everyone was focused on the consumer sector. And some people think we're really smart now because we made investments in Salesforce and SuccessFactors and Box and Yammer, but we made those investments back when it wasn't that popular. And it does take 5, 6, 7, 8 years to really grow a company to be of significant value. So we're currently benefiting from those investments we made when it wasn't so popular. Now, we've seen the consumer sector settle down, we've seen clean tech settle down, and a lot of investors are focusing on business software now. I'm not particularly worried about the people who have just rotated in. This is not an easy way to make money. It's really hard, and it takes a long time. So I don't think people who are pivoting from one sector to another really are going to make a big dent in the category. I think it takes expertise, it takes dedication, and we definitely have a lot of competitors in Silicon Valley. I think we compete with some of the strongest firms around, but we wouldn't have it any other way. I think we're looking to build global leaders, and they're going to attract very strong investors. But as you know, in Silicon Valley, our competitors are also our friends. We work together and sit on boards together. We learn from each other, and then we compete with each other on the next investment.
But have you had to relax your standards on valuations, if you will, or have you had to be more flexible with prices that you're willing to go into because deals are inherently getting more competitive? So even if you may have that advantage with given your kind of track record, if they can get a better offer somewhere else?
Yeah, I think we have to move with the times, and I think the story about forming EmergenceCapital was very much a story about, hey, we were adapting to the times. It was a horrible time, so we had to have an investment thesis that would work in horrible times. And I do believe that our investment strategy is designed not just for frothy times, but for bad times as well. And so as we look at the current environment, we are seeing some higher prices, more competition. Some of the things we're doing are investing a little bit earlier, so ensuring that we get the same ownership for the same amount of money by taking a little more risk. We also are investing more broadly geographically. So for the first 5 or 6 years, I would say all of our investments were in Silicon Valley. Our most recent investments were in Denver, in Dallas, in Edmonton, Canada, and we just did an investment in Buenos Aires. So we are looking more globally. We still look to build global leaders, and we think that the U.S. is a key component of global leadership. So some of these companies from other areas, we're helping them build sales and marketing teams here in Silicon Valley so that they can become the U.S. leader on their way to becoming the global leaders.
Yeah. Talk a little bit about your investment in Argentina. So you first invested in Restaurando, if I'm right, and then the founder of Restaurando recently started this incubator of sorts, and
Yes.
You're the lead investor in that.
Exactly.
So talk about a little bit about what it's sort of you're investing in a venture fund almost. What you expect to see from that, and why does Buenos Aires look like it's, why does it look like there's sort of a greenfield opportunity?
Yeah, so I've said a few times, we think that we really started investing in SaaS because it had the ability to disrupt the large software companies. What we've realized is that the leader in the U.S. in a SaaS market is being pulled internationally to other countries. People in Europe, people in Latin America, people in Asia, they want to work with the leader of the U.S. market. And so the U.S. leader is kind of the incumbent, the natural global leader. What we have seen by studying some of these, especially these emerging economies, the BRIC markets have this great phenomenon happening where there's an emergence of a middle class, which both increases consumption and production at the same time, and really provides a market for technology. And many cases, they are leapfrogging the U.S. by going straight to that leading technology that it's available in the U.S. today. As Anna mentioned, I've been to Russia, we've been to China, we've been to India, and in all of those cases, the markets are large enough that they are spawning a lot of startups targeting those regions, and we haven't been tempted in those markets as much because the local companies are so intrigued with the local markets that they're not thinking about the world. What we've seen in Latin America, on the other hand, is a smaller market, and so they need to think more globally. They're not just thinking about the regional market, they're thinking about where they can play on a global stage. And we believe that that market is also the least developed, and therefore it's still possible for this firm that we're working with to be the leader of B2B software in that market.
Yes, I mean, just a little bit more on that. What's the idea behind the company? Sorry, the name of the company again is?
Quasar Ventures.
Quasar, right. So you invested a few $1 million, the Series A, right?
Yeah.
And so the idea is that they will use that money as their investment capital. They'll be sort of a seed venture firm, and that gives you a window into innovation in Argentina?
That's exactly right.
So let's talk a little bit more broadly about what you're seeing in enterprise software. To me, perhaps the most interesting story over the last couple of years has been the emergence of Amazon.com as an enterprise software company. So you have a company that for years has been working on e-commerce margins, which is to say zero margin. Now all of a sudden they are the backbone of how startups are developing and doing business. It could have been, I mean, by people who are smarter than I am, it could have been predicted a few years ago, but certainly not by me. What does that do to the overall landscape of enterprise software? And do we start to see Amazon as, looking 5 to 10 years from now, are they among, the leaders when we talk about the enterprise?
Yeah, I mean, I think Amazon I think they were brilliant for entering the public cloud space I don't know if you've talked to them, but they fell into it by accident. They started providing e-commerce storefronts for other e-commerce providers, using their scale to operate, to really provide their infrastructure as a service to other e-commerce players. And as they grew, they realized that they had a cost advantage over really anybody in the cloud. And so I think that was a brilliant move for them. I do believe that their lead is substantial enough that they will continue to be relevant for the next generation of infrastructure providers. I think what's interesting mostly to me is that Amazon is such a powerful consumer brand, and many of the other consumer technology providers are using the strength of their brand to ride into enterprises through the workers, with workers procuring technology and applications and bringing that into the workplace. And Amazon really, despite their consumer brand, isn't using their technology that way. They're really targeting the IT department, which is a new sales channel for them. But they got in at the right time, and they've really done an excellent job. So, that'll be an interesting one to watch.
And roughly what percentage of your portfolio companies build on AWS?
Not that many. What we find is it's more popular among consumer applications than business applications. I would guess maybe 20% of our portfolio uses AWS. Probably more than that, but less. I'm thinking of a smaller percentage that really use it as their core infrastructure.
And so for their core, are they typically using colo facilities, or are they using other cloud-based solutions that are perhaps more kind of enterprise ready?
Yeah, so we have a number of companies that use the Force platform at Salesforce.com. We have a couple that use the Google platform. I think a lot of B2B software companies can get started on a public cloud, but they tend to want to build their own private cloud before too long.
So Salesforce last week announces its biggest acquisition ever, ExactTarget, $2.5 billion. And this is one of the themes that we've been talking about for the last couple of years, which is, does the SaaS market play out the same way that the on-prem market did, which is that it's a sort of it's chaos for a number of years, and then the consolidation happens, and then there are two runaway winners that just buy up everyone. And of course, that was Oracle and SAP, and to a lesser degree, Microsoft in the legacy world. Clearly, Salesforce is using that playbook to some degree, and it would make sense since there's Oracle DNA at that company. But is that is that what happens now? I mean, does Salesforce become the great consolidator, and then perhaps Workday uses its liquidity and equity value to do some of the same, and perhaps some of these others that now are $4 or $5 billion companies, or can we can independent companies just kind of go forever because of various distribution mechanisms?
Those are a good set of questions, Ari. Let me start working on those.
Sure.
So I do think that the on-prem software market has consolidated more than most of us would have guessed. And really, I believe the reasons for that are that, the software industry is really interesting. The ecosystem spawns what I'll call garbage collectors. And it happens, no one likes an old software company. It kind of smells like day-old sushi. So as soon as the market starts to smell that a software company's future is maybe limited, the multiple comes down, and it becomes very accretive for another company to come in and buy it. Of course, Computer Associates was doing this, a couple decades ago, and Oracle started to perform that function in the last decade. But I really think that the reason why the traditional software market has become over-consolidated is because it took a while for the SaaS generation to get going. It was during very rough economic times, and it takes a while to build scale in the software service market. So all during the decade of the 2000s, the SaaS market was growing, but it was pretty nascent. And meanwhile, Oracle recognized that they could use their high multiple to buy low multiple companies. That hasn't worked in SaaS. So while Oracle's bought a couple SaaS companies, those have been at strategic multiples. So it's not this consolidation play, it's more of a strategic acquisition. And I believe that for the foreseeable future, we are going to see a healthy SaaS ecosystem with a couple large suite vendors and 2 to 4 best-of-breed providers in each of the key segments. So I don't believe that we'll see that kind of over-consolidation really until there's another wave of software beyond the current cloud computing wave.
So the $4 billion plus that Salesforce has spent in the past year, I believe, doesn't concern you that there are just Oracle 2.0?
It makes me delighted, actually. No, for a long time, we always avoided Salesforce because they originally told us, well, we can't buy more than a $10 or $20 million company. And there are some negative accounting effects in software as a service. If you book a large contract and that's sitting in your backlog as a SaaS company, when a buyer buys you, that buyer cannot recognize the remaining portion of that contract until it renews. And it's kind of a perverse accounting concept, but it's really negative for SaaS companies. And so what that means is the best buyers for SaaS companies are very large companies where these effects don't really have a big effect on their bottom line. So I believe Salesforce has now entered the realm where they can swoop up a SaaS company and pay multiple billions for it without worrying about those accounting effects.
What are you seeing in the highly regulated industries, the obvious ones being financial services and healthcare, which for years were reluctant, and sort of downright adamant that cloud had no business in their business. It was their firewall and nothing goes beyond it. There definitely seems to have been some paradigm shift, maybe not a complete one. I know you guys are investors in some of these kind of vertical SaaS companies. Maybe you can talk a little bit about what you're seeing there.
Yeah, so when we first started investing in SaaS, first of all, we had the Salesforce blueprint. We thought, we just want to do that in every industry that we can find. But we were absolutely looking at the on-prem software industry and thinking, gee, the largest companies are providing horizontal applications. And while there's vertical software companies, they tend to be smaller. So we should focus on the big ones. And of course, we invested in Salesforce and SuccessFactors and companies with these horizontal applications. But as we've learned more about how SaaS works in the enterprise, we've become more and more convinced that there can be some large vertical industry plays. And if our recent investments have a very strong vertical theme to them. And some of the reasons why we think that are, if you look at the number of workers in different industries, some of the biggest industries with the most workers are not well satisfied by horizontal applications. So I'm talking about healthcare. I'm talking about financial services.
And a horizontal application, for example, is?
Horizontal application would be to serve the needs of a particular industry, or a horizontal application would be to serve needs that span industries. So things like sales and marketing, things like human resources, things like accounting. The good news is these companies can sell to every industry on the planet. The bad news is they have to sell to every industry on the planet.
And they're selling the same thing.
And they can't, it's hard to target customers who have a particular need. A vertical industry solution would serve just the workers, say, in the transportation industry or healthcare industry, and solve a problem that is specific to that industry.
Are you seeing many multi-billion-dollar opportunities in the verticals?
I think it's still nascent. I think I'm the only VC I know who talks about horizontal SaaS opportunities, but I think it is a natural evolution, and we'll start to see more and more of these success stories. Today in the public market, there's companies like DealerTrack or RealPage that are vertical plays. But certainly the entrepreneurial activity that we're seeing and the companies we're funding, we expect to see more of those.
What legacy enterprise company is most at risk right now?
So, I think if you look at some of the big technology giants, companies like HP and IBM and Microsoft, they all look like toast to me. Okay, but I also think these are the companies that have been able to survive from one architecture to the next, one paradigm to the next. And it's not pretty to watch an IBM go through one of these gut-wrenching transitions. But I do think there's something in their DNA, something that they've learned along the way that helps them think through how they make these kinds of shifts, which are really difficult. If you look more at the software layer, there are not many companies that have been able to shift from mainframe to client server to the web to the cloud. So in some ways, these big technology dinosaurs could be better off than the software companies that really have a tremendous shift to make as well. I do think that companies like SAP and Microsoft are making big strategic acquisitions And that's what's necessary to make it into the next generation. And SAP in particular, really bought some key SaaS properties, SuccessFactors and Ariba, and they empowered them as opposed to try to assimilate them. And ultimately, that seems like the best strategy to me.
So which of the legacy companies is most at risk? If I give you Cisco, HP, Oracle, SAP, it seems like you've said IBM can make the transition.
Yeah. I mean, again, HP looks really sick to me, but the scary thing is if you've got one of these legacy brands, you may have some DNA that can help you move into the next paradigm, but a single CEO could screw it up, could flush the whole thing down the tubes. And you look at a story like Apple, and you can see how that thing had one foot in the grave and the other on a banana peel, and it was saved just in time.
One company that nobody's talking about now that we'll all be talking about in 3 years, and it can be a portfolio company or not.
That everyone's talking about now?
That no one's talking about now, but we'll be talking about in 3 years. I'll give you 5 years even.
Well, so we have a company called Viva Systems that no one knows about, but I'll tell you about it. They are a vertical SaaS company. They serve the pharmaceutical industry. They have a CRM product that is built on the Force.com platform, but it's only sold to pharmaceutical sales reps. This company has been our most capital efficient company. It has only taken one round of venture capital, about $4 million, and should go public this fall. Multiple hundreds of millions of dollars in revenue and growing extremely rapidly and extremely profitable. And so I think when these numbers become public, people will start to see some of the reasons why we're excited about vertical SaaS and how capital efficient it can be.
What's the one that got away?
Well, there's a lot of ones that get away in the venture business. Obviously, we can't invest in every company. I think Marketo is one that we're kind of licking our wounds about right now. Obviously, it's had a very successful IPO and really become a global leader. And when they approached us many years ago, we had made a conflicting investment.
Which was in?
In marketing automation.
It was in the company you invested in?
Genius. So we
sort
were
of ironic, but
yes, it wasn't so smart. So yeah, we were conflicted and unable to participate.
Where do you fall on the sort of viability of freemium in the enterprise as a way to establish a market presence, establish a brand, and then try and monetize? You were obviously an investor in Yammer. That turned out really well, but there was a lot of questions about the real viability of Yammer's business given the sort of freemium nature of it prior to that acquisition.
So we're big believers in freemium. We've seen it work. We've seen it work at Yammer. We've seen it work at EchoSign. We've seen it work at YouSendIt, Box, and we've got others that are less famous. We don't believe that it works everywhere. You need a certain amount of virality. You need a certain amount of, you need to be able to charge enough so that you can support a large base of freemium users. You need to target large markets where you can live off of a small percentage of conversions. So it doesn't work everywhere, but we are now in the habit of looking at each opportunity and trying to do the mental experiment. Is there a freemium strategy that we can use? And so I know some people still don't believe that it works, but we absolutely do believe that it works in the right places.
And what would be the what would be the key metric that you would look at to believe that it's working if you're not yet at the point where revenue is a big enough metric?
I would say it's extremely complicated. When we're looking at a freemium business, we're looking at how do you give a value proposition for someone that's free that will be sticky and cause them to continue to use it and get addicted to it? Will they infect other users? So a free user in isolation is not of much value, but a free user who's in constant communication with coworkers, that free user may be extremely valuable even if they never pay you. Is there a value proposition that will cause people to upgrade? How much will they pay you? And really that, the amount that they pay you should be at least 50 times the cost of serving a customer. If you're assuming a 2% conversion rate to paid, that means you're gonna have 50 free users for every paid user. So it's gotta be very cost effective, and the price that you charge the paid user has to be able to support all that. So it's really all of those things, and I think if anything is missing there, it may not work. I don't think there's one metric that we look at. Obviously, you need delighted users who are committed to the product and using it regularly. Otherwise, none of the other things work. But you still need all those other components.
Yeah, I mean, one of the questions out there for certainly one of the more successful startups or one of the more high-profile startups is Dropbox, and you're an investor in Box. Dropbox has come at it from a consumer angle and is trying to morph its way into the enterprise. There are folks that would say they don't really have to morph their way because the enterprise is morphed, and it's just the nature of things now is that people adopt technologies, they bring them in the office. Box comes at it from more of a traditional point of view, which is we have tons of salespeople and we push the product, and we go for large contracts with CIOs. Do those two things continue to converge? And I don't mean to ask the consumerization of the enterprise question, but I guess that's kind of what I'm asking. Do they continue to converge to the point where you could actually see yourself investing in consumer companies because you see the enterprise potential, even if they're not really talking about it as such?
I think this consumerization of the enterprise is creating a really interesting blend of consumer DNA and business DNA, I think Yammer is a good story where David Sachs, the CEO of Yammer, he came out of PayPal and had great product DNA and was really a guy who obsessed over the product and really was world class there. But he knew that was a necessary component but not sufficient. That in order to really scale up as a enterprise business, we needed salespeople. We needed customer support people. We needed to be able to handle security audits. And there's a layer of things that an enterprise company has to do that consumer companies don't need to do. And I think while Dropbox has obviously got users within the enterprise, I think I do believe it's going to be hard for one company to both make consumers delighted and self-service and able to love their products and acquire them without friction. And on the other hand, those same products, when sold into an enterprise, are going to have another layer of needs that consumer brands may not be able to fit. And we're constantly trying to create companies that really can take that consumer DNA and blend in these enterprise functions as well.
Are there any questions out there for Brian? I have some more I could throw at him, but and I don't know if there's a microphone coming around or not, but we can start here and we'll see if here we go.
Sorry, one thing I quickly wanted to point out, we've gotten a couple of questions from Twitter. I'll read some of them afterwards. But some people in the lunch break came up to me saying they're trying to tweet for me to take a look at the questions, but their Twitter was blocked. It was private. So if you've been trying to tweet questions, you've got to see one of our teammates. Look for anybody that has orange on their badge, and they'll be able to help you unlock the privacy settings on Twitter so that I'll be able to read it.
It's like the early days of Twitter.
Like Twitter, but closed.
Hi, Andre Bliznik, EmergenceCapital. Brian, you've talked a lot about the enterprise, but I think one of the important features of a lot of the SaaS applications was that they also enabled small and medium businesses where they didn't have access to the technology previously. Could you talk about that a little more and how you see that evolving? Thanks.
Sure. Yeah. So really, there's no single term to encompass business software from the very small business up through the enterprise. So in many cases, we just use the term enterprise, but we really are focused on business software. And one of the great things about cloud computing is it scales. So it scales up, and you have companies like Salesforce serving the largest companies in the world. The really great thing about SaaS is it scales down, and that is much harder to do. So Siebel Systems spent a lot of energy trying to scale up, but they could never even try to scale something like that down. And SaaS has that capability. We've noticed that a lot of service companies start as selling to small business, and then as they build functionality, they're able to target larger and larger companies and ultimately serve the entire range of size of customer. And that's certainly the path that Salesforce took, and we think that that's a pretty typical path in software as a service. There's some value propositions that are needed by small companies, medium companies, and large companies, and I think CRM would be an example of that. There's other companies that we run across that really have a value proposition for the largest companies only, like a big HR system. It's just not needed for small companies, and so it's SaaS, but it is targeted at the high end. And then conversely, we see companies that have SaaS offerings that really only fit the small end. So one of our companies, Bill.com, is a bill payment service, and it's a great service, but if you've got an SAP system, you probably don't need it. So we've had to become skilled at selling to all of these different markets and knowing how to help companies transition from one to the next. So we see it as a continuum, and we invest across the whole range.
Quick question over here. Dmitry Repin, Digital October. Brian, you sort of kind of were one of the first who jumped on this software as a service category. So do you see any other major areas, something becoming a service, like for example, television as a service that are coming and where you you might point out us or you are looking yourself?
Well, yeah, I think the big trend here is everything as a service. I think the reason why that's happening is the world continues to get more competitive, and everyone needs to focus their energy and their resources on the areas of competitive advantage. So 10 years ago, if you had a company of 1,000 employees, you needed to manage them with an HR system, and there was only one way to do it. You had to go out and buy one, install it in your company, hire enough people to make it work every day, and that was the only way to run a big company. It didn't create any competitive advantage. It was a necessary, but not a way to beat your competition. And HR is a great example of something that most people shouldn't put their best people on. They shouldn't invest tons of money in. They need to do it, but their competitive advantage is probably in how they sell, the products that they make, or their cost advantage. And that's really where the resources should go. So today, you don't need to go make a big multi-million-dollar expenditure like that. You can rent your HR system as a service for hundreds of dollars a month. And by doing it that way, you're going to get the best in a breed. It's going to be improved every month or so. It'll be state-of-the-art. And will it differentiate you from your competitors? No. It'll be the same system that your competitors are using probably, but it'll free up your resources to redeploy them to areas of competitive advantage. And so that basic principle is happening. The technology has now enabled that to happen with information, with your software and information technology. So I really see almost no limit as to what could be outsourced in this manner. We always say we wouldn't recommend that FedEx use a software as service logistics system, because then they would be no better than their competitors. That's an area where they should invest, and they should buy unique systems and have the smartest people in the company working on logistics. Same thing for a hospital. A hospital should put their money into medicine. You know, they shouldn't be hiring the best IT folks. They can get all that by outsourcing through a software service provider. So I'm not directly answering your question, but I'm kind of saying, you know, I really think that this is a natural trend that will continue for decades, and we will see more and more companies focusing on their core competitive advantage and outsourcing everything else.
Hi, Eugene Feldman from Rallyware. So listening to your overview of how you first started investing in software as a service, kind of like drawing parallels from like the internet in general, right? Like when it first started, basically the content that was available offline, it just got available online, right? So you would have an online newspaper, for example, right? And then with Web 2.0, something like Facebook, like that model of interacting with people would not be possible in the offline world. And for what you're talking about, the innovation in the enterprise, it seems that so far you basically take something that already exists, you make it as a service, and then you sell it in a different selling model. And so my question is, do you see companies who are innovating and like really leveraging the internet to enable the types of processes in the enterprise that would not be possible without that type of technology? And you know, just like there's challenges with introducing, you know, like a brand new Facebook, like what do you think are the challenges of introducing kind of like a brand new type of maybe like enterprise collaboration, or whatever you think are the like the specific use cases that maybe where that's emerging, and maybe a few companies that you think are doing it well?
Sure. Yeah, I think, you know, Salesforce is a great example of a company that disrupted the market leader, but as you point out, they're basically doing the same thing that Siebel was doing, but they put it on the web. And the advantages of moving to the cloud were multi-tenancy, which dramatically lowered the cost, the ability to serve a distributed workforce, and lower cost. And of course, lower cost usually wins. So that's a pretty compelling competitive advantage right there. But I think it didn't take us too long before we realized that just moving something to the cloud may not be enough of a competitive advantage to really propel somebody to be a multi-billion-dollar company. And we started looking more for what things can you only do in the cloud that cannot be done in other architectures. And I think these are the biggest opportunities. These are not just transforming an existing piece of software to a piece of cloud software. It's doing something new that just wasn't possible before. And I think, you know, social networking is a fantastic example of that. Of course, you couldn't have a social network in a closed ecosystem, closed technology environment. But once the consumer world discovered consumer networking, the business world started to take notice because all of their workers are involved in this and bringing that knowledge and technology into the workplace. So that has spawned an incredible wave of social software for businesses. And I think I didn't forecast that 5 years ago, but it's happening today. I think Yammer is a great example of real great functionality that is built on a technology that just couldn't have existed prior to the cloud. So I think innovation multiplies on itself, and we are seeing now that innovation is happening first in the consumer world, and that's reversed from the way it happened in the 90s. But it gives us an early look into what what are businesses going to be dealing with 2 to 5 years from now? I think mobile is a massive opportunity, and we're seeing workers who never had access to a computer now walking around with a smartphone that's as smart as the computers we were all using 5 years ago. So that is new functionality that just you couldn't have tapped into those workers without the mobile phone. So we're always looking for these things that just weren't possible before, and they're hard. It does require predicting how people will use technology when in ways that they haven't used it before.
I think we have time for one more question. I see a microphone there.
Sorry, can I? Hi. I've been actually following Salesforce. I mean, it's easy to talk about it as a success story now, but going back then, Mark Benioff, he was seen as a crazy guy, very controversial. He made statements about big companies that people either loved or hated. He was ignored. He railed against, and he was a visionary. Now, the question is, as an investor, you looked at that guy and you had to believe in him because he personally drove that company. He was Salesforce. Now, VCs are not known for a long-term outlook. They need returns in few years time frame. Now, with him, it took much longer. Mobile space helped him a lot. He didn't know that tablets would come along, and mobile phones, and would have this functionality and so on. But what does it take for a VC to believe in the new turn? And software as a service, let's not forget, there were previous incarnations of that, and they didn't work. So there were already burned stories. Now, as an investor, just give us your peace of mind.
Okay, there's quite a few concepts there. I do think that we believe that there was room for a new venture firm focused on service businesses, in part because the service businesses are very different from product businesses. You mentioned VCs, are not known for being patient, and I think this is a great example. We've learned in our business, you have to be patient. These companies do not explode overnight. When you're serving customers, you have to acquire them and keep them happy every day. And there's never a quarter when you double your business. You've got to build your business every day, keep your customers happy every day, and the benefits accrue over time. So we think to be successful in investing in SaaS companies, you have to be patient. If you're impatient, you're not gonna like this. So that's the answer to one of your questions. I think Mark Benioff is an unusual guy. I think a lot of VCs did not like him at all, and that in effect created the opportunity, I think, that we saw. We recognized that when we formed Emergence, VCs don't like this kind of stuff, and they're not used to it, and they're not really open-minded to building service businesses, and that was the opening that we exploited. I think Mark, when we wrote our first investment memo, the number one risk was Mark Benioff. We didn't know if he was going to blow up the company or make it into a giant success. He obviously made it into a giant success, and I think really his vision is remarkable. I mean, in many ways, I was skeptical of his cloud platform in the early years, but he made it a success through his own determination. And that's a lot of what entrepreneurship is about, is looking around when everyone says you're wrong and being convinced to do it anyway. So I love Mark Benioff.
All right, well, that's a great place to wrap up. Thank you so much, Brian. Thanks for the questions, and enjoy the conference.
Thanks all.